So first of all, let me thank you very much for the opportunity. I think the world of XYPN since we attended that conference in San Diego last fall. It was my first real exposure to XYPlanning Network, and I was totally impressed and totally blown away and really appreciative of how well I was treated as a vendor there. I thought you guys did everything well and everything was first class, and I really got a good sense of the excitement of the membership, and I think there's a lot of great things happening at XYPN. So even for us, just to have the opportunity to show you what we're all about, I really appreciate it, and I'm excited to do this. At the outset, I'll just sort of what I've got planned is a 10-minute presentation followed by a 5-minute demo. I think that should give enough time for Q&A, but is there anything specific that you would like me to address first? Anything you want me to, any questions you have for me right at the start?
I'm good.
Yeah, nothing from my end.
Yeah,
Okay.
no, I'm good. And I don't know a whole lot about the product, so I wouldn't even know what questions to ask.
Okay, good. Well, we can jump right in. Like I said, it should be about 10 minutes on the presentation, and then I'll just free-form a demo, and then we'll go from there. This is just the intro slide, and to start, I'll just draw your attention to the quote at the top from Harold Evensky, where he says, "The bottom line for investors today is being less concerned with the probabilities of success and more concerned with the consequences of failure." And just kind of keep this in mind throughout the presentation, because it is insight into how NestEggGuru is different from a lot of the other applications in the space. It's sort of how we approach the problem. So with that in mind, we'll move on and make sure I can get this set. All right. Okay. So this is a screenshot of the NestEggGuru homepage, and as our tagline reads, NestEggGuru is a suite of applications that may be white labeled and incorporated into a financial planner's client-facing website. And you might be thinking to yourselves already, does the planning world really need another goal-based planning app? And I can tell you, as a planner myself, I know that financial planning software market is a crowded and very competitive space. If I understand it correctly, I think XYPN has relationships maybe with MoneyGuide Pro and Riskalyze, and I think if I read the news in the last couple of weeks, we've recently engaged with Right Capital and Advisor too. In my own practice, e-money is a core element of my financial planning approach, and I know that there are lots of other competing applications as well. So with that in mind, let me assure you that NestEggGuru serves an entirely different purpose and provides an entirely different perspective from any of these other financial planning apps. Our software is not designed to create a financial plan. It's not designed to produce goal-based cash flow analyses. Instead, what our primary purpose is to engage and educate clients directly through the planner's website. And as you'll see, NestEggGuru is intended to complement rather than compete with broader financial planning software. So hopefully that gives you an intro. To drill down a little bit deeper, here are a few of the advisor problems that NestEggGuru was created to address. First, our view is that clients really don't want to receive presentations per se. They want to be engaged in the planning process. And second, our experience has been that most planning software does little to help with marketing or lead generation. And third, most professional broad financial planning software tends to be expensive. So I'll go through this in a little bit greater detail. As I'm sure the good people at XYPN would agree, the financial planning paradigm has been changing, and it's still changing over the last decade or two. Consumers today are increasingly sophisticated, and different from 20 years ago, they are no longer really impressed with a big, long, boilerplate, jargon-filled report that they're never going to read when they leave your office, and it's just forced upon them as almost a sales presentation. Instead, the value that the planner provides to the consumer is to educate them and to actively engage them in the planning process to make the whole thing tangible for them. And unfortunately, I think most comprehensive planning software today, including eMoney that I use, is still on the financial planning side, advisor facing. It's marginally interactive at best, and it still prints out reports that I think are way too long. Similarly, as a financial planner, you may have sophisticated and specialized planning expertise, but if your planning software is advisor facing, how does it help you raise awareness to people who visit your website that you actually have these skills? And how does it help you to attract new clients? We're 100% client facing. And our job is to inform all site visitors that you have college and retirement planning expertise, and then we immediately invite them in to engage and to learn. And the image here on this screen offers an example of how NestEggGuru can be incorporated into a website to both stimulate client interaction and to stimulate lead generation. We do have, as part of the subscription, a lead generation function that you can either turn on or off depending on how important that is to the advisor's practice. It's also worth mentioning that another vendor that I think really does this well is Riskalyze, and they have that whole concept of what is your risk number, which we think is actually a brilliant way to draw visitors into a planner's website. And we've sort of taken a similar approach in the way we present NestEggGuru and an advisor's website. And you can customize any way you like, but this offers a good example. In terms of pricing, in my practice, I pay more than $3,000 a year to subscribe to eMoney, in addition to a whole staple of other CRM and portfolio management apps. And at a certain point, I think most planners likely ask themselves, do I really want to shell out another couple $1,000s for another planning app? In my own case, I like some of the capabilities of Riskalyze or a Money Guide Pro, but do I really want to spend another $2,000? So let's face it, most financial planning software is expensive. And as I stated at the outset, NestEggGuru isn't designed to replace these other applications. Instead, it's created to be an affordable a la carte solution that you could easily complement your core financial planning software. So our regular subscription price is only $300 a year, and we'd be approaching XYPN as an enterprise level client, and we'd be happy to offer XYPN members NestEggGuru for annual subscription price of $200 a year. And having explained how NestEggGuru offers solution to those 3 common problems on that first slide, what I'd like to do next is to introduce you to some of the features in the software itself that helps set it apart from maybe some of the other college and retirement software applications that you've used before. Here we go. What makes NestEggGuru different? With respect to the first item on this list, nearly all broader financial planning software today uses Monte Carlo simulations, and NestEggGuru is the only one, I think, that employs bootstrapping simulations as an alternative. And if you're not familiar with that, in simple terms, the primary difference is that in your standard Monte Carlo analysis, whether it's Money Guide Pro or Advisor or Right Capital or eMoney, the analysis requires either the programmer or the user to make specific assumptions about the mean return and standard deviation of each asset class. In bootstrapping, we don't make any explicit assumptions about standard deviation or mean returns, and instead, we generate our simulations by randomly sampling from the monthly historical return data. So it's not historical backtesting, it's random sampling of historical data. And the data set we use is from 1970 to 2016. I'll expand on that a little bit in the demo. We're also very different from traditional Monte Carlo simulation software in that the results aren't expressed in terms of probabilities. And instead, we focus the user's attention on the bottom half of the simulation results, with the bottom 1%, 5%, and 10% simulation results being the value at risk statistics. They're presenting scenarios that are as bad or worse than anything on the historical record, which sort of gets back to that Harold Evensky quote in the beginning. We're looking at the consequences of failure. So the following frames, I'll expand on this a little bit further. This slide simply shows that despite the widespread use of Monte Carlo simulation software by our profession, it really is not without its flaws and limitations. And That's not to say that bootstrapping doesn't have its limitations too, because it very definitely does, and I'd be happy to answer questions about that after. But what we provide is really another way of looking at the problem, looking at viewing projections for college and retirement planning. So it's just a different perspective. To continue that thought, this is a screenshot of the output from NestEggGuru's retirement spending app. As you can see, instead of offering up a probability of success by focusing on the bottom half of the financial simulations, or excuse me, of the 5,000 simulations that we run, that's this shaded area here, medium to worst. Here are the value at risk statistics. What we're trying to do, and what I think we do pretty well, is actually provide clear, tangible questions or answers to the questions that I think worry our clients the most, the thing that keeps them up at night, which is, if things go badly in the investment markets, will I still be okay? So you can see here, by providing remaining balance data in 5-year increments over the entire range of spending simulations, in a single table, we make the concept of balancing retirement portfolio sustainability with the notion of leaving maybe too many chips on the table. We make it tangible and quantifiable to your client. So you can see the red are the simulations that ran out of money, and these are the risk, and you can see the time horizon here. So we try to make it really quantifiable. And with just a couple of quick clicks, we also make it really easy just to go back and for the user to change one variable at a time and see how the factors that they have some control over can affect the outcome. So this is a snapshot of our apps. In the next few slides, I'll quickly introduce you to a few of the unique features that we built into each one, and then we'll hop into the live demo. For the college saving app features, I think we're the only app that shows users what can happen if down years in college savings happen close to or at the date of matriculation, and which is obviously an important consideration if you're planning for your children's college or tuition payments. I think we're also the only app that allows users to test and compare age-based models versus a risk-based constant allocation portfolio model. And similar to the results table I showed you for the retirement spending app, we do a great job of giving the clients a very realistic range of where they can expect to fall. Our retirement savings app makes it easy to model saving strategies into various qualified plans. Like, for example, you could simulate a 401k contribution strategy, simple IRAs, whatever you like. And we enable users to model constant allocation versus declining equity target date portfolios that are common in a lot of 401k platforms. So it's also sort of a unique feature. Lastly, with the retirement spending app, we are the only app that enables users to test the importance of withdrawal strategy. And as I noted on this slide in big, bold letters, all caps, this is really a big deal, because every application that I've tried, including eMoney, Money Guide Pro, Advisor, all that, and the like, all of those applications automatically and implicitly assume constant allocation with rebalancing in their Monte Carlo analysis. However, I think you all maybe have read some of the same papers that I've read over the years. There's been a fair amount of research lately that has shown that this is really not an efficient way to spend down a portfolio. And for our part, NestEggGuru illustrates this point by allowing users to compare constant allocation with rebalancing against a stocks first spending strategy, a bonds first spending strategy, and a simple guardrail spending strategy. And to be clear, we don't proclaim that any of these methodologies is optimal either, but it really does a really good job of educating clients about just how important that decision is. And it's something I think that is, like a lot of other apps don't do, but it's a really big deal. It's one of the most important factors in determining portfolio sustainability. And as you've already seen from the results table, NestEggGuru already does a really good job of illustrating sequence of returns risk through the value at risk statistics, and we really make that whole concept of portfolio sustainability in retirement quantifiable and tangible. Lastly, this is the latest research paper that I co-authored with one of my NestEggGuru co-founders. It appeared in last month's Journal of Financial Planning, And my purpose in showing it to you is to point out that one of the reasons we created the software was to help bridge the gap between academic research and the practitioner. And over the years, we've all read papers by people like Jonathan Guyton and David Blanchett and Wade Pfau and Michael Kitces, and they present some great concepts that we'd love to use in our practice, but we haven't had software that available that makes it easy to illustrate those concepts directly to our clients. In this paper, all of the data that's presented was created using NestEggGuru. So we feel like we're making that available to the practitioner. Just as an FYI, these are some of the papers that influenced NestEggGuru's design, and that we wanted to be able to express the concepts that were in those papers. So having said that, it is now demo time, and I've got screen sharing here. Hopefully, can everyone see that?
I can see the demo time slide.
Yes, do I.
Okay. Can you see this slide I just dragged over it? That gives the 3 applications.
No.
No.
Okay. Let's see. How do I do that then?
You may try closing out of your presentation and going straight over
Oh,
to
okay.
the demo.
Okay, that's a great idea. Okay. Let's see. Screen sharing has stopped. The window is closed. Okay. Share screen. Here we go. All right. Okay. I think I see it. Desktop 2. All right. Share screen. Okay. How's that? Better?
Yeah.
Awesome. Okay. So this is freeform. We have these 3 apps. I'm happy to demo any one of them or all of them. I don't know how much time we have, but I will tell you the retirement spending app is the most robust. It was the driving force behind our creating the software. But if many of the XYPN people have younger clients who are more concerned with the saving side, I can illustrate those too. I'm open to suggestions. Is there any one that you'd like me to run?
I'd like to see the spending app.
Mm-hmm.
Okay. All right, let's do it. That's my favorite. That honestly is my favorite. It's what drove us to create it in the first place. So, okay. So here's the retirement spending app, and one of the things that I'll point out right at the outset is that many of the broader financial planning apps, those core applications, take a fair amount of time to enter client data, client input data, and from our perspective, again, we're engagement software. We're designed to be both intuitive enough for consumers to use and to be highly interactive. So as we say right here, it should take less than a minute to enter the data, and we make it really easy to go back and change one variable at a time. So it's truly intended to be interactive. I'll just run us through it quickly. And let's see, sample client. So we're going to illustrate a spending strategy. In this case, I've set up the default scenario so that it actually gives a good classic illustration of a spending model. So in this case, we'll use a 30-year time horizon. We can change it with a slider bar. You can change it manually. We'll use a nice round number to start with. We'll use an initial portfolio value of $1 million. And I've set this up. Again, you can change it to whatever you like, but $45,000 initial withdrawal amount, and it's 4.5% withdrawal rate. We'll adjust for the cost of living. Again, all of these you can change to whatever you like. We'd allow you to adjust for up to 2 future changes in spending, either up or down from the portfolio. For now, we'll just assume no future planned adjustments to make it easy. And we ask the user to put in their broad asset allocation. Here we're using a basic 60-40 allocation. And we also ask the user to put in their detailed stock allocations. And for your reference, we're using the S&P 500 index as a proxy for U.S. stocks, Russell 2000 for small and mid cap, and MSCI EFA for international. Again, we're using monthly return data from 1970 to 2016, and we're randomly sampling with replacement for those. You'll notice that we handle bonds and cash much differently. When we first set up NestEggGuru, we were using the we're using Merrill Lynch Corporate Bond Index or the U.S. Treasury 10-year return data for simulating, for random sampling for bond data, but with interest rates near historic lows for the last 10 or 15 years, if we kept that data in, and this is a problem with a lot of Monte Carlo software these days too, we would be overly optimistic relative to what people can actually expect to get today. So to overcome that, we simply ask the user to put in, what do you realistically think you could get on bonds and cash today? For bonds, using something like what could you get on a 5-year CD or maybe the 10-year Treasury. So in this simple example, we'll use 2%. Again, you could change it to whatever you think is realistic. For cash at a lot of places is 0. And lastly, this is also a source of over-optimism. In some applications, it's very important to account for the impact of investment expenses. That's both internal and external. Again, you can change it to whatever you like. In this example, I'll just use 1%, but it can be 0.5%, whatever you want it to be in quarter percent increments. And then lastly, here's the one that I talked about in the presentation. I'll set this up using constant allocation with rebalancing as a starting point, and then I'll show you how you can change it and what a difference it makes. So those are the 11 basic inputs. We run 5,000 simulations in about 5 seconds, and our reports are pretty straightforward. We actually give a couple of paragraphs on this to summarize the data, and then we present the data in tabular and graphical format real clearly. So as we say at the outset, instead of focusing on a single probability of success, we believe it's more instructive to present users with a full range of simulation results representing a broad spectrum of potential economic conditions. And we encourage people to focus on the bottom half of the simulations, and in particular, the bottom 1%, 5%, and 10%, those value at risk statistics. So in this example, in terms of the summary, 52% of the simulations lasted for the 30-year time horizon, 48% ran out of money before then. We put the top 20% result in, but we encourage people to disregard that. It's, no one will ever complain if they have more money than they had planned for. And the worst, the portfolio was depleted. And here again is that table that I showed earlier, focusing on the bottom half. This should make it tangible to your clients. You can see in the bottom 10% simulation result, the portfolio ran out of money between 20 and 25 years. Now you can look at this data and say, okay, this makes me a little uncomfortable, or in some cases they might say I'm fine with it. But if you want to see how it's intended to be interactive. This is not a single plan. You go back and change variables one at a time and see how change factors within your control can impact the results. So in this case, let's just go back and we'll change from constant allocation to a guardrail strategy, not entirely dissimilar to what Jonathan Guyton wrote about. It's a little bit simpler, but basically this guardrail strategy basically says don't sell stocks when they're down. And as you can see, changing that one factor makes a significant difference in the sustainability of the portfolio. You'll notice we don't use the word probability anywhere. And here again, you can see. So it makes it easier for the client to understand how they're doing and to make decisions about whether they should change anything or not. In terms of reporting, when we print the report, or you can save it as the PDF, it is customized to the advisor. In this case, it's customized to my practice. There's my logo prepared for sample client. It has my contact info here. It has a short bio, and we present the inputs, then the summary, and then the complete simulation results in graphical format and in tabular format, and then our disclosures. And you'll notice at the end, we also allow users to put in their own firm disclosure. So that's what it looks like. I'm happy to answer any questions you guys have. I can run different demos. Does that give you a feel for how it works?
Yeah, this is Mike. It does. My question is, so is the idea that you put this on your website for like prospects or anybody to use? Absolutely.
Okay. Absolutely. Now we actually have some subscribers who don't even have a website, and for them, this is there are two ways that you can build it into the website. We give everyone a subdomain, their own URL, and they can share that with clients, or they can just use it from their office and run it with clients in their office, which is if you have a big screen in your office, it's a great way to do it. But we also give each subscriber, here's my own account. Where is it here? Oh yeah, here's my own account. We also give them an embed code, so you can hard code it directly into the website if you like. It can be customized any way you like. Just, you know, you can work with your web designer to customize however you like. No one ever has to use the NestEggGuru logo. Some people do because they like it. It doesn't matter. You can see there's the lead generation function. You can turn it on or off. Customize your bio. Customize your firm disclosure. Hopefully that answers your question. What else can I do?
I like the idea of, you know, putting an interest rate in for the bonds, you know, because they are pretty low today.
Yep.
Is there a way, or have you ever thought about like doing a glide path with that, where, you know, maybe over 10 years it does go up a bit, because, you know, maybe someone thinks bonds will eventually kind of return to a little bit of normal?
We have, and we might. The tricky thing there is, though, I showed you those papers that influenced our writing, right, or our design of NestEggGuru. And one of those papers was Wade Pfau's paper on, I think it was the 4% rule is no longer safe in a low yield world. And in that paper and a couple of other pieces that he and some other authors have written, they talk about how the early years in retirement are the most important. And actually, I think they coined the term sequence of returns, risk, and bonds. So even we all accept that interest rates may be higher at 10 years from now than they are today. If interest rates stay low over the next decade, like they have, which is basically what we're trying to test, interest rates higher isn't going to save you. So we prefer to err on the side of conservatism and assume that interest rates stay low. And, you know, again, this is the difference between financial planning software and engagement or interactive software. You know, we're not developing a long-term financial plan. We're trying to quantify that risk to the clients. What if rates stay low? You know, we can assume that rates go higher and they'll have more money and the results will be more rosy, but that's not our objective. Our objective is, you know, what we need to account for the possibility that rates don't. And like I said, you can go back and change it to what if rates are 3% instead of 2% on bonds, or 4%, whatever you like. But you know, we've gotten that question a couple of times, and you know, we can see the benefit. I think we might add it at some point, but for right now, that's the reason why we've structured it the way we have.
Okay, thank you. Yeah, I see your point.
Hey JR, this is Jeremy. I'm actually playing around with NestEggGuru on your website. Is there a place, like if you've got a 35-year-old filling out this information versus a 55-year-old? I mean, that's a 20-year difference of accumulation there. Is that going to accounted for anywhere in the input?
Yeah, here's how you should handle it. So you're talking about for the spending app, right? How do you get from the savings? Yeah. Here's how you do it. Now, the tricky thing is if you're 35 years old and you're saving for retirement, there's no way to realistically quantify how much money you're going to have at retirement. It doesn't matter whether 35 years or 10 years out. We don't have control over what the returns will be. So here's how I address it in NestEggGuru. And keep in mind, we're focusing on the consequences of failure, or assuming that things are average to below average to really lousy for over the period of time that you're testing. I would encourage somebody to run this retirement savings application first. So have your 35-year-old client, you know, if they're going to retire at 60 or 65, enter the appropriate time horizon. And then when you get the results from that, you get a range. We don't give a single result or a probability, it's a range. We would encourage them to take the numbers from the range and then take that as their initial value in the retirement spending app. So you might use the median and run it, and you might use maybe the bottom 1% and run it. Okay, what if this is a lousy 25-year accumulation period? And we'll use that 1% result as what we have in retirement and use that. So you can test the whole range. You can obviously run it interactively anytime you want, as many times as you want. But if you're looking for how much that 35-year-old will actually have as an initial nest egg at retirement, it's that, you know, median result to the bottom 1% and everything in between. We think that's a realistic range that people should plan for.
Gotcha. Yeah, that makes sense. I forgot there were multiple different apps. Okay.
Yep.
Cool.
Yep.
Then another question with that. So let's say, I mean, you were saying you use eMoney.
Yep.
I mean, is there ever a huge discrepancy between the eMoney more in-depth results versus what a prospect kind of ballpark through Nest Egg?
Absolutely, there is. In fact, one of the things that I'll tell you, I actually don't. I use eMoney for what I think is the trend in our world, which is everyone is visual and wants client facing. So honestly, I've used eMoney's financial planning software. It generates a 90-page boilerplate report. I'm a big fan of eMoney, but I can criticize them for that because I don't use their software. Their results are overly optimistic because the internal assumptions that they make for their capital markets returns are overly optimistic, and they don't fully account for expenses. Lots of issues. I don't use their financial planning software for that. What I use it for is that wonderful interface that my client can log into and see their accounts all their held away assets. We store their documents for them. I use it because it really has a great client facing presence, not as financial planning software, but as account aggregation and document storage. It makes relationships sticky.
Yeah. So
so
if you run a retirement plan through eMoney and it comes up different, you don't even use your planning. Like, this is your planning software for retirement planning.
Yeah, I'm me, and I wouldn't force how I wouldn't. Sometimes I tell people I wouldn't wish other advisors to do things the way I do. There are a lot of people who use Money Guide Pro, and I have lots of very good things to say about Money Guide Pro or InStream or any of the other applications. I said I don't really want to replace that. We're interactive, trying to show your clients how the impact of different variables. One of the complaints about Monte Carlo simulation software is, and this is Moshe Malevsky wrote an article about this several years ago. It was called, "Will the true Monte Carlo number still please stand up?" Because if you run a different application, I guarantee if you run Advisor, Right Capital, Money Guide Pro, and eMoney, you'll get different results from each one, and they're wide differences. And it's because the different internal assumptions and that it's the butterfly effect. One small difference leads to a huge change. So you just need to be aware of that. I think our value is in providing a different methodology, a different view. I think in general, when you compare them as much as you can, apples to apples, we come out more pessimistic. But again, you can account for that. In Money Guide Pro, you have the ability to go in and change the assumptions. So you could assume zero standard deviation for bonds and enter a fixed rate of return, just like we do. I think their default is a 3% or 2.5% return on cash and a 3.5% return on bonds or something. I actually have the data, but so you just kind of need to be aware of that. But generally speaking, we're designed to be looking at the value at risk statistic. We should most of the time be more pessimistic than the results that you get from a lot of the traditional Monte Carlo simulation software, unless you go in and mess with the internal assumptions yourself.
Gotcha.
JR, this is Taylor. You had
Hi, Taylor.
Hi. You had mentioned that there were some limitations to bootstrapping. So we've talked a little bit about the limitations to Monte Carlo, but would you share your thoughts on the limitations to bootstrapping?
Absolutely. So one of the big limitations that we have, and just everybody should be aware of that, is that we're limited to the number of assets that we can test. So you saw for equities, we use large cap, small and mid cap, and international equities. A lot of people have asked, so how about if can we do commodities or alternative investments? Can we do emerging markets? And the answer is no. And the reason we can't is if we, in order to run a reasonable amount of simulations, we have to have a large enough sample size. And like I said, we're running 50 years of data, 1970 to 2016, and we need to run enough simulations. And we run more than most applications at 5,000 sims. But the problem is there isn't index data going back 1970, as far back as we could go. You can't go back that far with emerging markets data. You can't do it with commodities. It just doesn't go back far enough. So we have too small a sample size from those. And I've seen other apps, not mainstream apps, but have tried to fudge by making up the data that goes into over those years. And that's really just not good science. So we don't do that. So we're limited in terms of the number of applications we can test. And like I said, one of the other limitations that if we stuck to what we originally did when we built the model, which was do random sampling from historical bond data, we'd be grossly overly optimistic. I mean, the mean return on bonds from using treasuries or corporate bonds from 1970 to 2016 it's much higher than rates are today. So we'd be grossly overly optimistic in our output too. So those are the limitations of Bootstrap. We think it's perfectly reasonable to use the equity random sampling. You know, I still believe random walk hypothesis is still as valid today as it was back in the 1970s. So our randomly sampling of equity returns we think makes a lot of sense, but we couldn't do it with the bonds and have reliable output. So those are the biggest limitations.
Okay, thanks. Yeah, that makes sense.
Yep. Anything else?
Would it be,
Do you have, oh, go ahead, Michael.
oh, when we're done discussing this application, would it be possible to show the college savings app?
Oh, absolutely.
Sure.
Absolutely.
Okay, sorry about
I can
that.
do it right now if you like.
Well, go ahead and do the other question first.
Sure, go ahead.
No, go with the college savings. I had more of a general call to action question anyway, so.
Okay, all right. Yeah, CTA is happy to talk about that. Actually, we have a neat CTA thing, so. All right. Okay, so college savings app. And I'll do again, sample client. So we can illustrate any time horizon you want from 0 up to 18 years. So we'll just, in this case, let's just do 10 years. College savings, I don't know, let's say, make it more realistic. $10,000 saved. We are a little bit different. You can enter either a percentage of income or a flat dollar amount. So in this case, let's just say save $1,000 a year. We'll run it out. Keep it small. You can increase by cost of living, or you can increase not at all. So in this case, let's just say we're just doing $1,000 a month for the entire period. What we're trying to simulate is, it doesn't have to be a 529 plan, but that's sort of in the back of your mind when you're running these. It could be just, you know, a UTMA account, whatever you like, but just to simulate the impact of saving for college. So in this case, we're doing $1,000 per year. We're not adjusting for increases to that amount over time. We'll assume it's a constant over the entire period. Again, you've got the flexibility to change it however you like. Our little, you can see there, we can do that. For asset allocation, same basic principle. And in this case, I think we're illustrating an 80-20. Same thing, you can account for cash and for bonds. And in this case, we'll, 1% for your average 529 plan. Obviously, it can be lower if you're using Vanguard or TIA Craft. You can set it to whatever you like. And here's the sort of the neat feature about it. You can use constant allocation, a risk-based model, or you can look at the age-based models, and you can customize it. So in most cases, the age-based models will end up with a 0% allocation upon matriculation. So declining equity, it'll be mostly cash at matriculation, and you can change that. We'll set it that for now. So right now, we're going to test without that, and we'll go back and change it. So using that simple example, we illustrated a 10-year period of saving $10,000 a year. All this shows you is the dollar amount that you actually put in this first result. And we started with, I think, $10,000. What we inputted in is a total, and then $1,000 a year for 10 years. And the median result, this is what you had, and the worst result was here. And then we present it in table form. So based on that strategy, you can show your client, this is the range of where you can reasonably expect to be based on the strategy that you're using now. And then you can change that by going back and changing any of the variables you want. So let's just say we increase it to saving $2,000 a year. And the investments are done monthly, by the way, in the application. And we'll just change it to a declining equity glide path. Again, we didn't adjust for inflation. We assumed constant amount. So $2,000 a year is now $20,000. The top 20% result is here. Something is not right. What did I change? Let's see. $2,000 per year, 10 years, 0% per year. Let's try that one more time. $2,000 per year. $10,000 initial savings. Go back to here, just see what that does. Okay, that's better. $1,000. Okay. Yeah, this seems to make sense. And there's the simulation range again. So bottom 1%, $30,000. I think I need to go back and do the glide path again. But again, you can get a sense for the full range. Do you have questions on this so far? Hello?
No, I'm good.
Yeah, it looks good.
Okay.
Yeah, nothing's jumping out at me.
All right. So it's not, we basically, we just rolled out this application. We had the retirement savings application, and we actually built this on the chassis of the retirement savings application because it isn't all that different. What is different is that in most of the retirement savings applications, if you're looking at a 401k and you're using a target date fund, for example, most target date funds upon the end of the period that you're illustrating end up at about 50% equities. In contrast, in the 529 plans, when you're using the age-based portfolios, they'll end up at 0% because obviously you need the cash for those 4 years of college. So it's just a fundamental difference. But you can test 50. You can in both the retirement savings app and this one, you can test that. So let's see, if you look down at the same idea, you can see the target allocation at retirement is 50% equities. But again, you can change it to whatever you want. Oh, you have to select it first and then change it. So good with that? Does that make sense?
Yes.
Okay.
I have a question. So you have these 3 apps. When you said there's the $200 a year, is that all 3 apps that are included in these?
Yes.
Okay.
Yep, it's all 3, and we probably will be rolling out some other applications. I don't know if we'll get to it by the end of this year, but for all of our existing subscribers, that includes all of them, yeah.
Great.
And JR, maybe I missed this, but when you're doing the college savings, is there room for like multiple kids? I mean, I guess you're really just looking at accumulation, not necessarily funding.
Correct. So you could look at it all together, but it's set up to be per kid.
Okay.
So you can see if you're, because the time, we're doing one time horizon.
Right,
so
right.
I think we're running a 10-year time horizon. Each kid would have, I have 4 children. So I'd be running 4 different illustrations. And obviously if you have a 529 plan, you've got, and depending on even the type of 529 plan, you've got some flexibility. You can change the beneficiaries as you need to. But yeah, we're doing it one at a time. I'll also tell you, we have a company that we met while we were in San Diego at the XYPN conference was EFC Plus. Do you guys know them or familiar with them?
Yeah.
Education funding software. They do a phenomenal job of helping people understand the financial aid process and maximize or minimizing the net sticker price of college, and have data for colleges all around the country, and helping people fill out the FAFSA and that sort of thing. They are similar to us in that they're a la carte planning software. So we have a partnership coming out with EFC Plus where we're marketing NestEggGuru with their software, because their software for college planning is they don't do anything on the savings and investment side, but these days the savings and investments honestly are less important than the aid planning process, and they're state of the art for that. And we think our software complements theirs. So we'll be pairing with Fred Amrine to pair our software with theirs.
Jared, could you mention the call to action feature? Could you? Yeah. Do like that?
Yeah, I have it on my website. Now I showed you that that slide on my website that. It's sort of like what Riskalyze does, where if you use Riskalyze, you can build into your website a line that says, what is your risk number? And ours is similar. So, let's see, I'll just, So here's my own website. It's easier just to demonstrate it by showing what it looks like. So this is my website. I have built that in as a call to action right here. So everything in website design these days is about making things visual. It's important to have video. It's important to have a strong value proposition message at the top. If you want to know how I know this, we went through a startup accelerator program, and some really people who work on user experience and website design told us that. So this is the CTA that I use for NestEggGuru, and each one of these is hard-coded into the website and allows the user, it's the two most common objectives in financial planning are college and retirement planning, either retirement savings or retirement spending. So this is your basic CTA. And if someone visits my site who is not a client already and hasn't run the applications before, if I have that lead generation function turned on, when they run the application, and run the application and they click the submit button, excuse me, the first time they run the app, if they've never been to the site before, when they click the submit button, it'll prompt them to enter their first name, last name, and email address. And it'll say in that message, the first report, we're going to email it to you. And it also says in there, because you want it to be as non-threatening as possible, you want them to give you that information. That first email just says, nobody's going to call you. The information about the advisor who's providing the report will be on there if you want to call them. And at the same time that report goes out, the advisor gets an email that says, congratulations, you have a new lead, and it gives them the first name, last name, and email address. People ask, shouldn't we ask for the client phone number in that? And we say, no, this is what we learned from user experience training, that in our profession, people are wary of phone call solicitations. If you ask for a phone number, you're much less likely to get that lead. So that's basically how lead generation works, and that's how we use it as lead generation in the financial planning Hawaii site. Honestly, you can custom design it any way you like. Some people have this just as a single call to action, and when they click on the link, you get all three of those NestEggGuru apps popping up, and they can run it from there. You can customize it any way you like.
All right. So, I just went in on yours. I didn't get prompted to put in my email address or anything. Did you have yours turned off?
No, I've got the lead generation. Okay. I got it turned off. Yeah, I got it turned off. Yep. Yeah, it was driving me nuts, actually. It'll only do it the first time. The other thing about a call to action and a lead generation function is you definitely don't want to irritate the people who are using your app. So it only the first time you run the application for your first time. It's not going to.
Got it.
Is that for a lead generation? Is that per test? So like if someone runs the Test Your College Savings, app, and then they provide the email and they come back and do the Test Your Retirement Savings, will it?
It'll only
guys they've been there?
It'll only do it once.
Okay, good.
No, yep. Just again, the key. There's so many little things I didn't realize that go into making a lead generation functionality optimized, and not irritating people is high on that list. So just one time, and we tell them, and we were very clear in the language on that it's just the first time you enter it. As a courtesy, we'll email you the report, and the advisor's contact info is there. Feel free to reach out if you like, and that's it. It'll recognize them unless they're using a different browser, or if they're running it on incognito, then they'll be prompted for it every time. But other than that, just one time.
And then, do you as the advisor see the results of what they put in?
No, and people have asked me about that. And the reason we don't is we have no. This isn't, and we don't. I should also say we don't want to integrate with MoneyGuide Pro or eMoney or any or other account aggregation software. We don't think that that's helpful. Actually, we think it's harmful. But we don't know what data the person put in the first. We have no idea whether that's their real data or fictitious data. All we're really interested in is getting a new contact. Somebody who was interested, came across your site, was interested in what you had, and that's it. From there on, it's on the advisor to get to know that person. Maybe you subscribe them to your newsletter. Maybe you send them an email. Hey, thanks for checking it out. Give me a call if you want. Whatever you want to do. But that data in that report isn't particularly useful to the advisor anyway. When we originally set up this in the beta test time, we allowed the reports to go to the advisor, and advisors got tired of getting the reports. You don't want your inbox filled up every time somebody runs a simulation either. So that's sort of the balance that we came to. I don't think that the software is so interactive. You're just changing one variable at a time. Some people might just run it and just run the test data the first time. Having that sent to the advisor doesn't really give them anything useful anyway.
All right. I mean, do you roll this? Who's your target market, I guess, with this? I mean, is it smaller RIAs, or are you looking at working with larger broker dealers, or who's the target recipient for this?
Like most, I don't know if it's like most. Basically, I created the software originally for me. So I'm like you. I'm a independent advisor. You see, Financial Planning Hawaii. I'm a one-man shop. There's 4 of us on the team. I have a developer. I have my co-author, Jack DeJong, is a professor in Florida, and we have another guy who runs our social media platform. But I created it with the idea that I was targeting people like me. So it's independent financial advisors. It's certainly independent broker dealers, firms like Ameriprise or Merrill Lynch or Wells Fargo, Finet. Those large BDs or independent BDs have no interest in this whatsoever. They have their own platforms. In fact, they actually openly reject it. So at the high end, we're looking for the small to mid-sized BDs, and more commonly the independent RIAs. That's the fastest growing segment of our industry anyway. So the fee-only planners, the RIA firms, that's really the target market. And there's a few 100,000 of us around. So.
Okay, makes sense.
Mm-hmm. Anything else I can do? And that.
Hey, JR, it's Maddie.
Yeah, hey, Maddie.
Hey, I was not listening the whole time, but I wasn't sure if you had talked next steps about maybe getting the members access to the platform and setting them up.
Absolutely. Yeah. So new members or people on the tech committee, I can easily send out a free subscription so that anybody who's on the committee and wants to try it and run it, I can send out. I can create a coupon code that would allow you to do it.
That'd be awesome. That's exactly what we'll want to do with the tech committee, because over the next few weeks, they'll take some time to kind of vet the product and play around with it and see really kind of how to use it. And then they're going to provide feedback. So that would really just be next steps. And I can send you that list of 7 members or so.
Sure. Absolutely. I'll just create a coupon code that makes it free. And now on that, just for the people who are listening on it, when I send that coupon code, make sure you actually apply the coupon code. Sometimes people, when they're going through the subscription, forget to hit the apply button, and then it'll prompt you to enter your credit card information. So you don't want that. So we'll give you the coupon code, and then it should be free.
Okay.
As long as you hit the apply button.
Yeah. Jeremy asks, will they be able to put it live on their website during the trial?
Absolutely. Sure.
Oh, cool. Well, then
do anything you want. Yeah. In fact, I'll open it. I mean, they can keep it for free for as long as I want. I'm not going to turn it off.
Oh, wow, that's generous. Cool. Well, then we'll let them play around with it, and this has all been recorded, so I'm going to be able to convert it and put it up onto our share it with everyone that wasn't here, and they'll try playing around with it as well. And then in a couple of weeks, I'll reach back out to you, and we'll certainly be able to extend the discount to members. And that's awesome. Thank you so much for your time.
Great. I like I said, I can't tell you how much I appreciate it. We're a small company, and this sort of exposure helps us a lot. So, and I really am a huge fan of XYPN. I think you guys are doing great things in making the financial planning industry much better for the consumer and much more objective and client first. It's a great thing, and it's serving the younger clients as well as older clients. I think it's great. So
that's awesome. That's all our members. So. Cool.
Yep.
All right. Thanks, everyone.
Yep. Thank you. Look forward to trying it.
Thank you. All right. Aloha.
All right. Aloha. Bye-bye.